Welcome to The Explainer. We're going to dive deep into the financial engine room of some of the world's biggest companies. We're talking about long-term liabilities. These are the giant promises that actually fund their most ambitious projects and, believe it or not, shape the world around us.
All right, let's just jump right in with a little thought experiment. Imagine a company, right? They've got this incredible, game-changing idea for a new factory. But the price tag, it's $1 billion. Now, they don't have that just sitting around in a bank account. So where does that money come from? How do they pull it off?
Well, the answer, most of the time, is something accountants call a, wait for it, non-current liability. I know, that sounds super technical, but all it really means is long-term debt. It's a promise to pay money back, but way down the road, usually more than a year. It's this incredible financial tool that lets them turn tomorrow's potential earnings into today's cash.
So to really wrap our heads around this, we're going to follow the story of our company and its new factory. We'll look at how they fund the future, dive into the world of corporate bonds, figure out if they should buy or lease their gear, touch on the rules they have to play by, and finally, learn how we can check up on their financial health.
Okay, first up, funding the future. Let's set the stage here. Why on earth would a company willingly take on such a huge long-term financial promise?
The bottom line is, it's all about unlocking growth right now. By promising to pay back money far, far into the future, a company gets its hands on the cash it needs today. Cash to build that factory, to fund some wild new research, or even to buy a competitor. It's really just a simple trade-off, a future promise in exchange for a massive present-day opportunity.
So how does this actually work? What's the most common way for our company to raise that $1 billion? Well, that would be by issuing something called a corporate bond. Think of a bond as just a giant fancy IOU. The company goes out to the market and basically says, hey, give us your cash now and we promise we'll pay you back the full amount on a specific date in the future. Oh, and we'll give you regular interest payments along the way. And the folks who buy these IOUs, they're called bondholders.
But here's where it gets interesting. The price of this IOU isn't always what's printed on it. It all depends on the interest rate the company's offering. That's called the coupon rate. If their rate is lower than what investors can get somewhere else, well, investors are only going to buy it for less than its face value. That's a discount. But if the company's rate is higher, then investors will actually pay more for it. That's called a premium.
Let's look at a real-world example. So there's this company that issued a bond with a face value of £1 million. But here's the catch. They were only offering 5% interest, while the going market rate was 6%. So were investors excited? Not really. The company only got $957,876 in actual cash. They had to sell their bond at a discount to make it attractive.
But, and this is super important, even though they got less cash up front, they still have to pay back the full £1 million when the bond matures. And you can see this on their books. Over the life of the bond, the value of that debt slowly climbs back up from what they received all the way back to the full $1 million they owe.
Okay, so our company has the money, the factory's getting built, awesome. But now they need all the heavy machinery to put inside. And this brings up a really big strategic question. Do they buy all that stuff outright, or should they just lease it?
This is a real fork in the road, financially speaking. They could go with a finance lease, which is kind of like a rent-to-own deal. With that, the machine actually shows up on their financial statements, their balance sheet, as both an asset they control and a liability they owe. Or they could use an operating lease, which is more like a simple rental. And, at least traditionally, with that option, nothing would show up on the main balance sheet. It was off-balance sheet.
So, that leads to a pretty obvious question, right? If a finance lease is basically like owning the thing, why would a company go through all the trouble to structure a deal as a simple operating lease instead?
Well, the answer is pretty simple. It made the company look a whole lot healthier to investors. By keeping that massive liability off the books, the company's total reported debt looked lower, and that made all their key financial health ratios look way better. Now, it's really important to say that recent accounting rules have clamped down on this, but for a long time, this was a huge motivation.
All right, so our company has its bonds, its leasing equipment. They've made a ton of big financial promises. And you can bet that the people who lent them all that money want to make sure the company plays it safe.
And that's where debt covenants come into play. Just think of them as the terms and conditions for the loan. They are literally the rules of the game, written right into the borrowing agreement, designed to protect the lenders by saying what the company can and can't do. And these rules basically come in two flavors. You've got your affirmative covenants. These are the must-dos, like you must maintain a certain level of financial health. Then you have the negative covenants. These are the must-not-dos. Like, you must not sell off a huge part of the business without our permission. You break these rules, and you could be in some serious hot water.
And it's not just about bonds and leases. Companies make other huge long-term promises that turn into liabilities. A really big one is a defined benefit pension plan. That's where a company promises to pay its retirees a certain income for the rest of their lives. That creates this absolutely massive liability that's all based on tricky assumptions, like how long people are going to live.
So with all these different kinds of liabilities piling up, how do we on the outside make any sense of it? The factory is up and running, but did the company take on a healthy amount of debt for growth, or are they walking a dangerous tightrope of risk?
We figured that out using something called solvency ratios. They're actually pretty simple, but they're incredibly powerful tools. They act like a quick financial health checkup, giving us a snapshot of a company's ability to actually meet all those long-term promises it's made.
They really fall into two main camps. First, you have leverage ratios, like debt to assets. They tell us how much of the company is financed with borrowed money versus the owner's own cash. Then you have coverage ratios. These tell us if the company is actually earning enough money to comfortably make its interest payments. The big one here is the interest coverage ratio. It's a great stress test.
And this is where these ratios get really powerful. Let's look at some data from back in 2008. We can see here that Nokia financed 11.2% of its assets with debt. Okay, so what? Well, you can immediately compare that to its rival, Ericsson, which was a little lower at 10.6%. That comparison, that context, is everything. And really, it all comes down to this. These long-term liabilities, they're not just boring numbers on a spreadsheet. They're like the architectural blueprints for a company's ambition. When you learn how to read them, you get this incredible insight into their strategy, their appetite for risk, and frankly, their overall financial stability.
So I'll just leave you with this. The next time you see a brand new skyscraper scraping the clouds, or a massive factory humming with activity, or you use a product that just blows your mind, ask yourself, what long-term promises made this possible? Because chances are, behind almost every huge leap forward, you're going to find a web of carefully constructed long-term promises that brought it all to life.